Chameleons and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's take a look at the share disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, are for informational purposes only concerning Market Chameleon tools and products. One last look at the disclaimer, and let's welcome Dimitri Pargamonic to the stage. We'll be talking about how to visualize and analyze implied volatility skew by expiration. And welcome, Dimitri. How you doing, buddy?
Good morning, Will. How are you?
Great. Let me bring your screen to the stage.
Yep. And let's. Oh, well, I can hear the background noise.
All right, I'll remove my.
Good morning, everyone. And today, what we'll do is take a look at the implied volatility skew, but we'll take a look at a particular option expiration in a stock that you choose, because the implied volatility skew could look different depending on the expiration you're looking at. And let's put in a symbol in our example. And I was just looking at MSTR, so let's take a look at that. You type in MSTR, you're going to go to that symbol's summary page on the left-hand side. What we're going to do is click on options, and then we're going to go to activity. And, or you know what? I'm sorry. Let's go to single leg dashboard. That's what we'll look at. So options, single leg dashboard. And what this does is bring us to a page that analyzes the trading activity for this stock based on just single leg option trades. So it filters out any multi-leg trades, contingent trades, and just looks at single leg options trades, which is just a order, buy or sell, a call or put. It's not tied to a multi-leg or complex order. I'm going to close this or minimize this menu to expand our screen. And for our purposes, we want to look at the implied volatility skew in MSTR. And I'm going to slide down here and to this table. Okay. And in this table, what we see is different option expirations available for symbol MSTR. So you see June 27th, July 3rd, organized by the days, right? How many days left to expiration. You could expand the screen. I think it shows the top 10. If you want to see more, just expand it. Let's keep it at the top 10 for now. And if we go across from left to right, we have the expiration, and then we have these data points, which are analytics based on what's going on within this option expiration. And what we're going to look at, because we're interested in the implied volatility skew, we want to see how does the implied volatility within that expiration change based on the strikes that are moving up, down from the at the monies. So the first implied volatility we see is if we go to a particular expiration. Let's say we're looking at July 18th expiration. We see that the at the money implied volatility is 47.1. Well, that's looking at just the at the monies, where it's creating a weighted average of the options that surround the at the money strike. So if you don't have an exact at the money strike, if the stock is, let's say, 367.18, well, we don't have a strike 367.18, so we look at the strikes around it and create a weighted average to see what would the implied volatility be around 367.18. And then once we have this at the money, 47.1, well, there are strikes that are higher than that. There are strikes that are lower than that. They move away. And what we want to have an idea is, what does the implied volatility look like as you're moving away from that the monies? Is it increasing? Is it decreasing? Is it staying the same, flat? And that gives us an indication what the markets are indicating about the volatility and the volatility skew as the stock moves away to, higher or lower. So
AD,
here, yes.
we did have a question pop up. Do you want to wait to the end to get to it, or should I give it to you now?
You could give it to me now.
Yeah, this was from, I think it was from Jim. He was saying, with regards to ER, I'm assuming that means earnings, and the IV crush, what is the correlation between the different expirations? IV and the IV 30 has a 15% crush. How does that relate to the other expirations?
I think that question is outside the scope of this implied volatility skew demonstration. But what we'll do is, let me take that question, maybe just look at it at a different time, because that'll require a different setup, looking at different analytics than that we're concentrating on today.
All right, I'll copy that down for Jim. All right.
All right. Thanks for the question, but I don't want to jump off this subject here today. So coming back to the implied volatility skew, we have this at the money, and what we want to know is, well, how do the other strikes look like relative to that at the money strike? And just if we had to just quickly get a sense of benchmarking the wings, we could run a straight implied volatility through each strike, and then find a 25 delta call and a 25 delta put, and see what the actual implied volatility is relative to that money. So that's what this is doing. It's saying that it's a little bit higher, 0.9% on the put, 0.9% or almost 1% higher on the call. And so it's the skew looks a little bit, 1% is not up that much, so maybe flat to the wings are pointing higher. Okay, so that's the July 18th expiration, and we could compare that across other expirations. So you could see the skew is a little bit more prominent as we get closer to expiration, especially in the puts. So if we see here, as we're getting closer to expiration, the skew in the puts are starting to increase more and more with less days to expiration. And before we chart this, another thing we might want to know is, well, how did that change on the day? So now that we know the skew, just like the stock price, well, you want to know on the day, did the stock price go up or down? Right? Because that gives you the indication what the markets were thinking today. Were they more bullish, more bearish? How did things get repriced today, given all the new information and trading activity? So this shows us how these same strikes from yesterday, how did we change? So if we looked at this strike, 47.1, and we compared it to the same strike, because this is looking strike by strike, we could see the change. So we could see that the whole thing shifted down. At the money shifted down, the put implied volatility shifted down, the call shifted down, the at the money's shifted down by a bigger percentage. So let's take a look at it. We're going to click on July 18th. And when you click on this expiration, it's highlighted blue. We did July 18th. You can see July 18th opens up. And now we see the implied volatility skew, or the implied volatilities for each of these strikes. So we know that here the the stock is around 367, right? So that would be that the money. So the 367 is like around here, let's say, or right there, right? So we could see that as the strikes go up, it's kind of flat and then starts to curve higher, especially like around here above 400, 405, it starts to curve higher. And as the strikes go down, the skew gets curves higher at a much faster slope, right? A much faster curvature. And then we have on top of that all the single leg option trades. So this removes any multi-leg trades, because multi-leg trades are, you're hedging one option against the other option. But if we look at just the single leg trades, we see the volume, a lot of puts traded here in a 350 strike, a lot of calls traded here in a 400 strike. So now we kind of plot the implied volatility and the option trading volume to get a sense of, how the trading activity may have contributed to some of the skew. So if the implied volatilities are falling, the implies that there's more selling. If they're increasing, implies more buying. So the other thing on this plot, before we interpret it, is it shows us the change from the previous day. So this gray line, okay, where we see this gray line, that's where the implied volatilities were the previous day. This other line with the dots, that's where the implied volatility moved to. Now that's where it's currently. So when you see a red dot, it means the implied volatility is lower from the previous day. If it's a green dot, it's higher. Okay, so we could see here that there's definitely shifting in the implied volatility curve. Overall, it looks like it shifted lower, and especially when we go out to the wings. But what is this curve kind of telling us if we were just interpreting, and what are the markets indicating? And here the markets are indicated the following based on the implied vols, that in this area here, let's say just visualizing it between 360 and maybe like 400, the markets are saying if the stock is moving, is going to be trading within that range. The volatility expectations seem to be that it'll stay relatively stable and neither decrease dramatically or increase dramatically, but in that range, the volatility is expected to stay in this kind of like 45 to 48 range. And it's starting to become more evident that if we start breaking out of these strikes, let's say the 400 strike to the upside, then the stock volatility is expected to increase, or the stock's movements, right, are expected to start to accelerate relative to here. Okay, that we could see a faster movement to the as we go higher and higher above the 400 strike. Or the markets look like over there, they're going to thin out. Okay, if you go through all this demand, then it's going to start thinning out, and the stock's going to move faster. On the downside, we see something similar too, that if the stock moves lower, let's say it starts breaking below 350 and moves lower and lower, the volatility or the speed of the movement, how the gyrations, the liquidity of the stock, that volatility is expected to increase even at a more dramatic pace, right? So we're seeing that this volatility is to the downside has priced in a much steeper implied volatility curve. So this looks like a smile where the both wings, right, are showing that if we break out of this particular range within the July 18th expiration, right? So we're looking at the July 18th expiration, that volatility is expected to increase at a higher rate to the downside than to the upside, but nevertheless both sides. But on the day, right, that curve went down. So whatever the trading activity or new information, new pricing in the options, that curve did calm down on the day. Right, it went lower on both sides. So that's quickly showing you a implied volatility curve within a specific expiration in a stock. And of course, not all of them will look the same. Let's just take a look at maybe the June 27th. So the June 27th expiration here looks different. These are the trade bars. We could see that to the upside, it seems relatively stable, maybe curving a little bit, and much faster to the downside. So let's take a different stock just as a comparison. Let's take a look at something like, let's take a look at Apple. So I'm going to type in Apple. Let's see if that looks different. So I'm going to come down to Apple. So Apple, here's July 18th Apple. If we, let's minimize this screen, the menu. I'm going to click on July 18th, and it's going to draw us the same graph. And here we see that this curve looks different. The Apple stock is, where is it? Sorry, 201. So it's like right around here. And we can see as the strikes go up and up, it looks like the implied volatility is expected to decrease, maybe level off over here. And if the stock goes down, it's expected to increase. So to the downside, we see an upward sloping curve. To the upside strikes, it looks like a downward sloping curve with flattening out, indicating that if we go up in Apple, the implied volatility or the volatility of the stock is expected to decrease as it's moving higher. It's going to move at a slower pace. Okay.
It's interesting looking at that skew because I was wondering about MSTR. For those who don't know, it's the company that buys Bitcoin and uses its leverage to buy the Bitcoin. So I was wondering how the upside, usually the skew flattens like this, where that upside skew actually did tick up a little bit, different than most other stocks.
Right.
So
which could imply, that as it's good, as if it's, because there's a correlation, you're correct, that this stock has some correlation to the Bitcoin because it holds Bitcoin, right? It's like a reserve currency. It holds Bitcoin, and I think a lot of the Bitcoin that it holds also is financed through either some of their software licenses. I think they do have sell software as well.
Yeah, they actually issue convertible debt and preferred shares to buy Bitcoin.
Yeah, and that stock will have some correlation to that Bitcoin. It's almost like a leveraged, right? It's like a leveraged bet on Bitcoin.
Yeah, 100%.
Yeah, so that gives us just a chance to take a look at the market expectations of what that implied volatility skew. So, Will, I think I'm going to stop there.
All right, D. Great job. Thanks for bringing us this webinar. It was very interesting to see the implied vol and the skew in MSTR and how it relates To other stocks, great job as always. Thanks everyone for joining. Remember to like us, follow us on all the platforms. Awesome job, D.
All right, thanks everyone. Stay safe out there. Have a great trading day. We hope to see you tomorrow.
All right, trade in peace, chameleons. D, thanks for doing this. Everyone have a great day. Remember to like, follow us on all the social platforms. Thumbs up on YouTube, always appreciated. Any comments or questions you have, you can email me directly, williammcbride@gmail.com, or any technical things you're seeing with the site, email support@MarketChameleon.com. With that, everyone have a great, safe trading day and enjoy the day. Bye.